Look at this split screen chart. On the left, a major currency pair like UR/USD makes a measured 0.5% climb. On the right, gold surges upward by 3% in the exact same window. When you sit staring at those massive price spikes in gold, it is entirely normal to wonder if your currency strategy is leaving money on the table. But relying strictly on raw price movement is a trap. Chasing an asset because it moves faster ignores the mechanical realities of how that asset is actually priced and executed. We are going to strip away the hype and break down the exact data behind both markets, directly comparing their hidden costs, their execution risks, and capital requirements. Your net return depends on how closely your strategy respects the mathematical boundaries of the specific asset you are trading. Trading AAU/USD means you are pricing a physical, finite commodity. Every ounce of gold represents a troy ounce of bullion weighed against the value of the US dollar. A major Forex pair is a pure financial instrument, measuring the relative economic health of two competing regions. There is no physical product changing hands, just shifting values of national money. Because of that physical scarcity, gold answers to global macro narratives. Its price responds to inflation expectations, shifting interest rates, and the demand for a safe haven asset during geopolitical conflict. Currencies operate on a much more rigid timeline. Their movements are dictated by granular economic data points, like monthly employment reports, and shifts in central bank policy. In the currency markets, you are trading a continuous tug-of-war between major institutions. You weigh the specific interest rate decisions coming out of the U.S. Federal Reserve against the corresponding policy statements and rate adjustments issued by the European Central Bank across the Atlantic. To succeed with gold, you have to read the global macroeconomic landscape. To succeed in Forex, you have to focus on the micro-level calendar, digesting scheduled data and rate differentials. This bar chart visualizes the scale of those differences. The average daily range for a major pair like EUR/USD typically hovers around 60 to 80 pips. Gold routinely clears 2,500 pips in a single session. That raw distance means you can hit a daily profit target in a matter of minutes, but that exact same momentum will trigger your stop loss just as quickly. Capturing those volatile moves depends entirely on liquidity, the ease with which you can enter or exit a trade at the exact price you want. The Forex market moves over $7.5 trillion every day. That volume creates razor-thin spreads, often under a single pip. Gold is heavily traded, but it lacks that overwhelming daily volume, meaning your base cost of entry, the spread, widens to 15 to 40 pips. High-impact news creates a surge of volume that can bypass resting orders entirely. This is slippage, when a market order fills dollars away from your intended price because the available liquidity vanished during the move. You pay a premium to access gold's massive ranges. The price of that volatility is extracted directly from your account through wider spreads and execution slippage. Navigating those costs requires structural changes to how you manage capital. Because gold carries higher execution risk, brokers demand significantly higher margin. You're forced to lock up more of your balance just to open the exact same position size you would in currency. The fastest way to empty that balance is applying currency rules to a commodity. A tight 50-pip stop loss might protect a Forex position, but on gold, that is practically background noise. Watch how this plays out on the chart. That tight red bounding box representing your standard Forex stop gets instantly crushed by normal market fluctuations. To survive gold's daily swings, you have to expand that boundary into a massive 500 to 1,000 pip defensive perimeter. To widen that stop without increasing your financial exposure, you have to adjust your lot size. If you risk $100 on a UR/USD setup with a 50-pip stop, your position size comes out to 0.2 lots. Now look at the exact same dollar risk applied to gold. To maintain that $100 exposure with a required 1,000 pip stop, you have to slash your position down to 0.1 lots. The lot size is cut in half. Traders often blow their accounts trading gold because they fail to make this exact mathematical adjustment, leaving themselves over-leveraged when the swings arrive. Ultimately, the choice between these assets is a trade-off between volatility and cost. Profitability happens when your specific trading system aligns with the mechanical realities of the market.
If you operate with a smaller starting capital and rely on quick, high-frequency entries, you fit the profile of a currency trader. The Forex markets give you the conditions you need for that approach: lower margin constraints, predictable scheduled volatility, and the thin spreads necessary for tight stop-loss execution. Conversely, if you hold positions for multiple days and trade off global economic themes, you fit the profile of a gold trader. Executing that strategy requires a substantial capital buffer. You need enough account equity to absorb those mandatory 1,000-pip stops without triggering a margin call, allowing you to ride out the momentum. This final matrix maps it out clearly. Smaller accounts and precise scalpers match with currency pairs. Well-capitalized swing traders match with gold. Review your capital and your strategy honestly. Select the market where the math supports your trading style, and let go of the need to chase the most aggressive chart on the terminal.